Well, key inflation figures have just been released. We're joined now by Alicia Barry for more on this. Alicia, this was lower than expected.
Yeah, it certainly was. The market was forecasting we would see inflation in the December quarter on an annual basis fall from 5.4% to 4.3%. Today we have seen the inflation rate fall to 4.1%. Now this is significant when you think about just how high inflation was in the December quarter reading in 2022. It was at 7.8%. So we have seen quite a reasonable fall over the last 12 months. And this is, I suppose, in a way, good news when you're thinking about the direction of interest rates. The market is anticipating that we might start to see interest rate cuts toward the back end of this year, and this number will only add to the case for that because, of course, inflation is heading in the right direction. The RBA would like inflation to be between 2 and 3% and really wants to see sustained declines in inflation from what have been very elevated levels, and we are starting to see that now. If we look at the main drivers of the CPI in the December quarter, it rose 0.6% in the 3 months of the December quarter, which has taken that read to 4.1%. The most significant increases were tobacco, along with housing, and there were most goods and services were rising, but albeit at a slower pace. The 0.6% increase in the December quarter is the smallest quarterly rise since March 2021. So we're certainly seeing inflation heading in the right direction. Whether or not the RBA is going to keep rates on hold or lift rates next week remains to be seen, of course, but all bets are basically that the RBA will hold interest rates. There's a 99% chance priced in by markets that the interest rate will hold at 4.35% when the RBA meets next week. So standing by to give us more information about the economic outlook and what the RBA will be thinking is Carlos Cacho, Chief Economist at Jarden. Carlos, thank you for making the time and standing by there. What do you make of these numbers?
Look, it's certainly a positive release for the RBA. You know, they were expecting that year-end inflation for December was going to come in at 4.5% for both headline and trimmed mean, which is their preferred measure. Instead, we got 4.1 and 4.2. So that's a material, fall versus their expectations. So they'll certainly be pleased to see that. That said, in the detail, it is a little bit less positive. The RBA and Michelle Bullock in her, communications late last year really was focusing the RBA's attention on services inflation. And there we've seen less positive progress. Services inflation was steady at 1% on the quarter. It did slow to 4.6, but it is still very elevated. Non-tradables inflation was steady at 1.2. That's still over 5% year on year. So really the deflation we're seeing is all coming through, or largely coming through, the goods channel, and particularly imported consumer goods as supply chains have normalised. And things have gotten back to normal. But if you combine this data with the softer retail sales data, the labour market data we saw earlier this month as well, it certainly makes a strong case for the RBA to remain on hold. And so, market is going to continue to expect cuts are going to be coming at some stage this year.
Now, you mentioned the services sector is still holding a little sticky. Is that going to mean that there is a risk that the RBA will move higher in spite of those forecasts pointing to rate cuts later this year?
Look, I think there is still a risk. I mean, the way the RBA has framed it is that they will essentially, as long as they think they're still on that glide path down on inflation to 2 to 3% by 2025, they've done enough. If something happens that pushes them off that expectation, that suggests inflation is going to remain higher for longer, then they might have to do more. At this juncture, with this data, I'd say that path is probably still broadly correct. But if in 3 months' time we're sitting here again and services inflation is continuing to hold up at 1% a quarter and above 4% year on year, the RBA might have to think that maybe a little bit more is needed. A lot of that pressure on services is coming through areas that the RBA doesn't have that much of an impact on. It's things like insurance premiums, which are rising at the fastest pace in years at over 16%. It's rents, which even with the effect of Commonwealth rent assistance are still rising at 7% and probably going to remain pretty close to double digits for most of the next 2 years in our view. And those things, the rate hikes aren't really going to help that much. So you're kind of relying on, everything else to moderate if some of those more persistent drivers of services inflation remain high.
Yeah, you mentioned the labour market and the pullback in retail sales, as well as those high rents. I mean, it is a bit of a tricky time out there for households. What is the broad economic outlook, do you think, for Australia? Will we just sort of muddle through and the RBA will cut interest rates throughout this year and we'll have a much lower growth? Is that your view?
Look, I think the economy is actually doing better than what you would judge by the headlines and the stories we're seeing in the media. Absolutely, there are households doing it tough. The combined effects of inflation, of rents, of interest rate hikes are impacting many budgets. But there's also a not insubstantial cohort who's actually doing pretty well. If we look at demographic data from the banks, for example, we see that older households are still spending very freely and doing pretty well. They've got cash in the bank. They don't have much debt. And so really, the Australian consumer is a very bifurcated story where younger households, particularly mortgaged households, are facing a lot of pressure, while older and wealthier households are generally doing okay. Outside the consumer, the export sector is still quite strong. We've obviously got the rebound in education, which is creating some other issues. Commodity exports are still generally pretty solid. Business investment is holding up surprisingly well. And the government, we can't forget the public sector, which is driving a record share of growth at the moment. The public sector now represents close to 30% of GDP, which is pretty massive. And that's probably only going to increase from here once you factor in the huge amount of infrastructure spending that's coming down the pipeline, along with the cost blowouts on the NDIS, which is now expected to balloon to over $125 billion a year. And so I think all in all, once you add it together and you factor in the very strong migration we're seeing, which, while it does create challenges in areas like rents, it does overall support growth and support the economy. And so I think we'll probably end up with growth being soft but okay in aggregate. And the RBA will probably, they will cut rates in time. We still think the risk is it could be into next year and not this year. But, we are seeing things moving in the right direction for that.
Yeah, as you say, on aggregate, things are performing particularly well, but the devil is in the detail. When you start digging in, there is a bit of a demographic divide and some people are really feeling pain in the community. Yeah,
there's those households, particularly those people who borrowed at the peak of low rates, during COVID, borrowed a significant amount of money. We know that a quarter of mortgages almost taken out during that time were on 6 times debt to income. Those households are going to be, certainly feeling a big squeeze in their finances from the cash rate where it is. But there are a lot of households who, only a third of Australians own their home with a mortgage, a third own their home outright, and a third rent. And so that third who owns their home outright, who often have savings in the bank, who are benefiting from reasonable deposit rates for the first time in a very long time, are actually doing well. And it's really it's a bit of a story of haves and have-nots in the Australian consumer space at the moment.
And Carlos Cacho, just to wrap, can you give us a quick sense of what this inflation number means or is telling us about the Australian economy and where you think rates will go next?
Look, this data on its own would suggest that the RBA has done hiking. The detail is a little bit less positive, but certainly inflation is moving in the right direction. It's suggesting that, goods deflation is certainly coming through. If we focus in on imported consumer goods, it's very much, we're seeing prices go backwards now. That's both a sign of a soft consumer as retailers return to discounting, as well as a normalisation in supply chains. What we really need to see, though, to have a higher degree of confidence that we're returning to that sustainable 2 to 3% inflation range that the RBA wants to target is those services and labour sensitive components of inflation come back a bit closer to target. And I think if we look at looking at the detail, things like housing construction costs are still rising at 5% year on year. They're down from 20%, but they're still pretty high and well above target. And that's a challenge. And we know that there's labour shortages in the construction industry. So I think it's still telling us a story of an economy that is a bit unbalanced, and that there are still some pressure points, particularly on the services side, that are going to be hard to bring inflation back to 2 or 3% than maybe we hope.
Carlos Cascio, appreciate your insights. Thank you so much.
Thanks.
And Gemma, just looking at the market reaction, the Australian dollar has fallen a little bit after that data was released, that softer than expected inflation reading, pushing the Australian dollar down to 65.8 US cents, while the Australian share market has lifted a little on hopes of interest rate cuts.
Alicia, thank you. After 93 years in the business, vacuum cleaner retailer Godfrey's has gone into voluntary administration.